Hi, this is Evan Hutcheson, and today I want to go over how to read the financial statements of your company and how they are interconnected. It's hard to go over this without going over basics of bookkeeping, which is credits and debits. So this is basically a two-in-one video that also shows you those basics. I'll go over two of the three primary financial statements, which are the balance sheet and the income statement. I will not go over the cash flow statement today, which is also a very important statement. We just don't have the time for it. So, all the accounts that you use when keeping your books are either listed on one of these two statements, either the balance sheet or the income statement. The balance sheet has the assets accounts of your companies, and the liabilities and the equity accounts of your companies. The income statement has your revenue accounts and your expense accounts. Your balance sheet is called a balance sheet because it's always in balance. As you can see here, the assets always equal the total liabilities and equity, 12.4, 12.4. There are glitches sometimes in bookkeeping systems like Quickbooks, for instance, that will cause the two not to be equal. But I've done hundreds or thousands of financials. I've reviewed probably thousands of them, and I've only seen that happen just a few times. So it's very uncommon. The reason it doesn't happen that much is because even if the bookkeeper doesn't really know what they're doing, financial software programs like QuickBooks will kind of be they'll kind of be dummy proof. If you don't have your your debits equaling your credits, it probably usually won't let you record the transaction. So these financials that we're looking at right now, they're obviously pretty bare. There's not much to them. I'm going to show you a few transactions, and I wanted to have those transactions flow through to these financial statements, and I didn't want anything else to be on the financial statements, just so you can better understand them and see how bookkeeping flows through to the statements and how the statements are connected to each other. So I hope that'll make it easier. Here are some of the transactions right here. The first transaction is your company purchases supplies from a vendor for $100 and they pay cash. So remember, debits increase assets and expenses. Credits increase liabilities, revenue, and equity. So the assets and expenses, these are the expenses on your income statement. These are the assets. Credits increase liabilities and equity and revenues. That's pretty important to remember. So, you purchase supplies, you're increasing supplies expense, so you're debiting this expense account. You're decreasing this asset account, which is cash, by $100, so you're crediting cash. If you instead credited supplies and debited cash mistakenly in your bookkeeping, you would be decreasing supplies and increasing cash. Now that would work if you returned your supplies to the vendor and they gave you your money back. That's what you would do. But if you purchase the supplies, this is the entry that needs to be made. Another example, journal entry 2, it's a little bit more complicated, but it's still pretty simple. Say you have a note payable. You borrow money from the bank. Now you have monthly payments that you have to make to the bank. If you're making a payment on a liability, you are essentially decreasing that liability because you're paying it off. So you would debit the liability. Of course, the bank's not going to give you money for free. They're going to charge you interest. So an interest is an expense account. You can deduct the expenses from your revenue. To increase the interest, you would debit it. So you're debiting interest. Say you're paying $500 for the note. I just put these numbers in arbitrarily. They're just for simplicity. but the $500 payment includes $100 of interest expense, which you're debiting, and you're decreasing the liability for $400, the principal payment. So you're debiting interest, you're debiting the note payable liability, and you're crediting cash for the amount that you paid. So each transaction you put in the system would have two sides to the entry. And as you can see here, both sides, they're always going to be equal. The end result is an income statement that shows your net income. That's your revenue minus your expenses equals your net income. And a balance sheet that shows all assets, all liabilities, and all equity. Where the assets, like I said before, equal the total liabilities and total equity. You might be wondering how the balance sheet will balance if some of these entries that you're making, just about all of them, have a portion of the entry going to the income statement. That's because the net income of the income statement flows through to the equity of the balance sheet. So that $4,050 right here flows through to your equity right here. Your equity is essentially how much you have invested in the company from, personally, minus how much you've taken out, how much you've withdrawn from the company, plus your company's earnings, aka your company's net income. One more example is if your company invoiced a customer for $5,000, they are going to, they offered some services to a customer, and the customer hasn't yet paid their bill yet. We would report sales, which is a revenue account of $5,000. Remember, revenues, to increase revenues, you credit them. So you would credit sales for $5,000. Accounts receivable is an asset account, so to increase assets, you debit them. So we would debit accounts receivable for $5,000, credit sales for $5,000, and also you purchased a software subscription on credit that you now owe to your vendor, but you have not yet paid, for $750. That expense will be debited because you're increasing software expense, and the payable will be credited because you're increasing the liability. So here's the entry. I know this is really just two entries. I just combined them into one to save time. A debit to AR for $5,000, a credit to sales for $5,000, a debit to software expense for $750, and a credit to AP for $750. Now, also you need to note that the balance sheet is basically just a snapshot of your business. So this is a snapshot of your business as of December 31st, 2014. The income statement is not a snapshot. It's for a time period. So this, as you can see right here, is for the full calendar year ended December 31st, 2014. Also note that this is a very, of course, short video on a very detailed and complicated subject matter, so I can't go over all the details of everything. I'm trying to just go over the main points in regards to bookkeeping and the financial statements. So there's a lot of other considerations that you'd have to take into account. You might have cost of goods sold, for instance. You might want to operate on the cash basis rather than the accrual basis, in which case you wouldn't record any sales or the software expense because you haven't paid this yet and you haven't received this yet. And depending on your entity, whether you're a corporation or an LLC or a sole proprietor, you might record it a little differently as well. So there's a lot of different issues involved. We're just kind of going over the framework here. And then finally, I forgot about this journal entry too. Your initial journal entry. Let's say to start your business, you had an initial investment of cash that you brought into the business of $8,000. So you're increasing the asset for $8,000. The way you got that $8,000 is $3,000 from personal funds. So you're crediting the money that you put into the business under members' equity for $3,000. You're increasing equity. And a credit from the bank for $5,000. So you borrowed $5,000 from the bank, you're increasing note payable by $5,000. So this transaction and these three transactions equals these financial statements. So if we look at the balance sheet, the cash is the $8,000. I hope you can see this. It might be small on your computer, but the $8,000, that is your initial investment. You know, you borrowed $5 from the bank and you brought in $3 personally. Minus $100 for the supplies that you paid for, minus $500 for the note payable that you paid off the first month of the bank loan. The AR, or accounts receivable, is just that $5,000 that you have not yet received from your customer. So that's total assets right there of $12,040 or $12,400. Your AP, or accounts payable, that's the money that you owe to the vendor for the software subscription. The note payable was initially $5,000, but you paid off $400 of that in your $500 payment. Because remember, $500 was paid out, $100 went to interest, and $400 went to the note payable. So the $5,000 investment minus the $400 payment has a balance of $4,600, and the member's equity is the $3,000 that you put in plus the net income that you're showing. The net income that you're showing is $4,050. So this $4,050 flows through to your balance sheet right here, and now your balance sheet is in balance. Your income statement has the $5,000 of sales, the $100 of interest expense, the $750 of software expense, and the $100 of supplies. So that $5,000 minus these expenses equals your net income. So that's a really quick video on a large subject matter. So I hope this helps. Let me know if it doesn't. Thanks.